The energy war, global markets on the brink, a comprehensive look at the massive shifts as of March 14, 2026. The global financial center of Dubai was rocked yesterday by debris from intercepted drone attacks. Major firms like Citi, Deloitte, and PwC have partially evacuated the Dubai International Financial Center, DIFC. Iran has officially threatened U.S. and Israeli-linked economic targets. This isn't just a regional spat, it's a direct hit to the heart of Middle Eastern finance. Brent Crude has smashed through the $100 mark, hitting $103.14 barrel on Friday. Oil is up over 40% in just the last 15 days. Are we entering a 1970s-style stagflation era, or can the global economy withstand the great oil shock of 2026? The Federal Reserve is expected to hold rates at 3.5 to 3.75% next week. The rate cut dream of early 2026 is dead. The Fed cannot cut into a supply-side energy shock without risking hyperinflation. Markets are obsessing over Kevin Warsh, the leading candidate to succeed Jerome Powell in May. Analysts are asking whether he'll have any room to move given the war-clouded outlook. The US dollar index is at a multi-year high. That protects American purchasing power slightly, but is crushing emerging markets and making global oil, priced in dollars, even more expensive for everyone else. The Strait of Hormuz is under a de facto closure. Only a handful of tankers are crossing daily. 1/5 of the world's oil consumption passes through here. The U.S. has issued temporary waivers for sanctioned Russian crude and eased restrictions on Venezuelan oil just to keep the lights on.
The International Energy Agency has authorized its largest ever emergency reserve release, yet prices still rose 7% this week. The market views the deficit as structural, not temporary.
Automotive. EV demand is cooling as electricity costs, driven by rising gas prices, surge. Consumer discretionary names like Ulta Beauty are taking double-digit hits, down 10% or more, as consumers pivot spending toward fuel and food. Big Oil is benefiting. Shell and BP are posting 2 to 3% gains even on down market days. Defense contractors are seeing record backlogs, with global military spending revised up nearly 15% for 2026. Bitcoin is holding steady above $70,000 even as equities sell off.
Institutional investors are treating Bitcoin as a hedge against geopolitical failure. For the first time, Bitcoin's correlation with the Nasdaq is breaking. It's trading more like a commodity than a tech stock.
Ethereum and Solana are seeing increased on-chain activity as users move capital into decentralized stablecoins to avoid currency volatility in the Middle East and Asia.
The IMF has revised 2026 global growth down to 3.3%, but warns that a protracted war could drop it below 2.5%.
Action plan. 1. Watch the 110 oil level. If Brent breaks 110, expect a massive equity sell-off. 2. Cash is a position. In a 3.5% interest rate environment with high volatility, holding cash isn't missing out. It's ammunition. 3. Hedge with commodities. Maintain exposure to energy and hard money assets like gold and Bitcoin. The world changed this week. Don't trade the market you want. Trade the market you have.